interest to all the stakeholders. The buzzword is GST these days, and we are at the threshold of introduction of this new tax or the existing tax in the new form, which is going to be or believed to be a game changer. We have a very eminent panelist, ably led by Mr. Satya Podar. Mr. Podar is a partner, policy and advisor in the Ernst & Young in India, and he heads the indirect tax practices. Prior to joining EY in India in 2005, he was with the firm in Toronto since 1987. Before that, he worked with the Canadian government on GST issues and tax reforms. With a brief introduction, may I request Mr. Podar to take over the charge of this session. Thank you.
Today, it's been a very challenging day, not only for us to get here, but also for the GST Council, which is debating the future of GST. So it's a double challenge, and I hope that we would still be relevant after 1 or 2 hours. There's a press conference anticipated at 6:30 or 7, and I hope they will have still a job to be employed at after that. The GST ride so far has been full of unanticipated events, surprises, on again, off again, and off again, and who knows what will happen. Just as a quick update, the winter session of Parliament ends on 15th of December, and the model law for the GST, IGST, and SGST is to be approved, at least at the central level, by the 15th of December. And with the disruption in Parliament for the past 7-8 days continuously because of demonetization, we don't know what will happen. So at this stage, we are proceeding as if it's going to happen. Now, I think the GST is indeed going to be the game changer. In fact, yesterday, Mr. Jaitley said that there are only 2 game changers, the demonetization and the GST. Before demonetization thing became a reality, there was only one game changer, that was the GST. And at that time, we were really saying, well, it's not really a game changer, but a name changer. But it may now become a game changer. And one of the things, there are really 2 aspects of the GST which we are going to talk about in the panel discussion here. One is purely the very broad conceptual redesign of the tax system that is going to take place because of GST. GST has been described as a grand bargain. What makes it a grand bargain? Now, these are things which are fundamentally going to alter the face of tax system in India, and it'll make Indian tax system unique, which is not found anywhere else in the world. Now, what are those features? Number one is, under the current constitutional arrangement, the taxation powers of the national and the state governments are mutually exclusive. This was the divide and conquer policies of a British Empire. They divided the taxation powers between the center and the states. The center could tax something that the states cannot tax. States could tax few things that the center cannot tax. Under the GST, there's a fundamental departure from mutually exclusive allocation of taxation powers to concurrent powers. GST is the only tax in the whole of the Constitution which can be levied by both levels of government on the same base. Number two, at the moment, the taxation powers are exercised individually by each of the states and the center. And that can be best described as a model of competitive federalism. The 31 governments are competing with each other to get the taxpayers' base in their own jurisdictions. Sometimes they get that base by providing incentives. Sometimes they tax that base by having very aggressive taxation of what passes through their borders. The model of the GST is called the cooperative federalism. Now, the risk is that the cooperation may become collusion. And at the moment, when I see the tax rates coming at 28% or even higher, I really feel that the governments are really not cooperating but colluding to beat the hell out of taxpayers. Let's see what happens. The third important feature of this grand bargain is origin to destination. Right now, many taxes are levied at the point of production, either because the taxes are limited to production process like excise duty, or in other cases, the taxes are levied on origin basis as opposed to destination basis. The classical example of an origin-based tax is the CST, Central Sales Tax, on interstate movement of goods. That tax is collected in origin state, not the destination state. GST has been designed to get rid of all the origin-based taxes and replace them by a pure destination-based tax. Of course, what is the destination of a supply is a question of definition, and we'll look at that. Another point is autonomy versus harmonization. And that has been the biggest dispute or point of resistance between the center and the states. At the moment, the center and the states can exercise their taxation powers in an autonomous fashion. Under the new system, neither the center nor the states have the autonomy of designing the tax system. The tax system can only be designed collectively. And the goal is that when they design the tax system collectively, it'll be a harmonized design. So these are very fundamental departures from the political and the future of the country's tax system point of view. Now, all of these four topics, or the four departures from the current system, took us 9 years of dating, as I call it. And the constitutional amendment was passed in June, and now we'll have the baby delivered in 9 months' time, which will be April 1. So that's exactly 9 months, July to March. So these are the broad features that make it a game changer or the grand bargain. Now here, look at the special features. Welcome, Prashant. At one time I was told that VAT and the GST is not a common system, even though people use the VAT and the GST for types of taxes. But one time one professor told me there are at least 113 different types of VATs or GSTs. Now, Indian GST makes our list 114 because Indian GST does not fit the description of any of the 113 GST that exist in the world today. Why so? Here are some of the unique features of it. In all the countries in the world that I know, there are only one tax, which is called the VAT and the GST. In India, we'll have 3 taxes. So it's not even a dual GST as people were talking about. It's a triple GST model, IGST, CGST, and SGST. Number 2, this tax will be completely paperless and completely cashless. The administration for the GST is designed to be completely cashless. And now you appreciate why our Prime Minister had to go for demonetization. That whatever chance was there to pay the GST in cash is also gone. Now you have to pay the GST in a cashless manner and paperless manner. So you can use the currency, but currency has to be electronic, not the paper currency. Returns you filed are all automatic. So it's a fully automated system, and if I can say so, it is going to be the world-class system, best of the best. It may not be simple, but from the technology perspective, the government of India is sparing no effort whatsoever to make the IT system world-class. Third feature is, and this is very unique, that the law requires the dealers or businesses to apply state-wise. So even though we have been talking about and those fiscal frontiers will be even more daunting than the customs frontier that you face on the international side. Now, an important consequence of this fiscal frontiers, and I hope my transfer pricing people were here from the rest of the room to hear, that we will have a thriving practice for transfer pricing under GST. And I guarantee you that you will be more in demand. than all of the income tax transfer pricing people, because those transfer pricing people are only talking about cross-border transactions internationally. Here we'll have 30 borders within India. And the law says that any exchange of goods and services between two registration numbers of the same legal entity will be subject to GST. So if you make a telephone call from office in Bombay to the office in Gurgaon or Delhi, wherever it is a supply of a service, you have to track it, you have to value it, you have to collect tax on it, you have to pay the tax on it, and then apply for the refund of it. So this is going to be, in the Income Tax Act, we only have one simple transfer pricing rule. You pay the tax on the arm's length value, the fair market value. But we are not to be left behind as indirect tax people. We have 3 pages of valuation rules, and Rohan will talk more about it, whether those 3 pages or 30 pages. Now, next feature is that our base is truncated. All the taxes around the world of the GST and VAT type, the first thing they define as a component of the base is petroleum. Now, under GST law, the first thing that is excluded from the base is petroleum. Second thing that is included abroad is alcohol. And the second thing that is excluded from base in India is alcohol. Third thing is, all the modern VATs and GSTs around the world include tax on real property. In India, that's to be excluded. Electricity is included everywhere else, but to be excluded from India. So you have major exclusions from the base, which make the base very truncated. In addition to the truncation of the base through these exclusions of electricity, real property, alcohol, and petrol, you also have, as you may have heard, 50% of the consumer expenditure basket is going to be exempted from tax. In most countries around the world, exemptions are no more than 20% of the basket, 15% of the basket. In New Zealand, it's 0% of the basket that is exempted. In India, the GST Council has decided to keep 50% of the consumer outside the base. Now, supplies without consideration, but not without tax. Because the law requires that a company or a taxpayer to apply in each state, the moment you apply for registration in a given state, you are treated as a separate legal entity. Not legal entity, but a distinct person. Now, any exchange of goods and services, which we call self-supply, supplies without consideration, because when I get a meal served at my home by my wife, it is a supply without consideration. There may be consideration in kind, but at the moment there is no cash consideration. But under GST law, that supply, there's a state board in the middle, has to be valued and tax collected on it. Now, that example may look very funny to you, but here's a practical situation. Ernst & Young has offices in Gurgaon, which is in Haryana, Noida, which is in UP, and Delhi, which is a separate state. Now, we have a cafeteria or a kitchen for the employees, which brings lunch. Lunch is cooked in Noida, and then it's catered to 2 other offices. Now, tax will be applicable on the catering of or cooking of the lunch in Noida, but now that same lunch, having been cooked, is being shipped to 2 other locations. That is supply without consideration, because the supply between the 2 hands. Under the GST law, that has to be valued and taxable. Other example of supplies without consideration are free samples and gifts. Now, even though they may be free, but they're not free of tax. Now, in the model law that has been released, the tax will apply not on the supply of those, but by reversing the credit you claimed for those. Now, destination-based place of supply rules. Now, place of supply rules under Indian Indian model law are going to be very unique, because in most of, if not most, in all of the foreign countries, only thing that you require is the destination of the supply or the where the supply is made. In Indian tax law, it is equally important to know from where the supply is made, because if origin and destination of a supply is not in the same state, then it becomes an IGST. And it's only now that people are waking up to the complexity that arises because of this unique concept that the place of supply or the place of taxation and type of tax you apply depends on both the place of destination as well as the place of origin. Now, input tax credit restrictions one most significant feature of the model law is that no credit is allowed for any inputs that become a real property. So take the example of this hotel. Hotel is fully taxable on its output, yet anything they buy as an input for construction of this hotel will not be creditable. Now, one of the biggest beneficial feature of the GST type tax is no double tax. Either you tax the output or you tax the inputs, but not both. Now, this restriction really amounts to double taxation. Credit refund for exports and for inverted duty structure. If your input tax rate is higher than output tax rate, you will get a refund for the excess credits. But in all other cases, leaving aside exports and inverted duty structure, you will not get a refund of the excess credits. You have to carry them forward. Other excess credits are to be carried forward. Lastly, there are very substantial transition relief provisions. Now, what they mean and how they mean, but the one important thing that has been tabled by the government in the model law is anti-profiteering watchdog. If you have a relief provided for transition relief for the credits, even going forward, if you have a relief provided, government has put in the condition that you will get the benefit of those relieving provisions only if you are not profiteering from it. And there's going to be, personally, I'm very sympathetic to this provision, but administration and implementation of it can be very painful or could be benign. So these are all the unique features, and I hand over the panel to Sachin, and he's going to dwell on many of these unique features in some detail. We only have 2 hours. To have a proper discussion, we perhaps need 2 years, and even then we won't have any definitive conclusions. So back to you, Sachin.
I will introduce Sachin.
Yes, please.
Before we request Mr. Menon to take over the charge of the panel discussion, may I have a pleasure of introducing him. Mr. Sachin Menon is the partner and the national head of indirect taxes at KPMG India. He is currently the co-chairman of the GST task force at the Federation of Indian Chambers of Commerce and Industry FICCI, and the chairman of the GST Committee, United States IBC. He is also ex-chairman of Bombay Chamber of Commerce and Industry and a member of Indirect Tax Committee of CII Maharashtra State Council. He has been recognized as one of the top 10 most admired Asia-Pacific advisors on indirect tax by International Tax Review, ITR. With this brief introduction, may I hand over the panel discussion in charge to Mr. Menon.
Thank you, Mayur. So before we start this the session, I would like to introduce the panelists here. We have Prashant Deshpande, who is a known name. We need not no introduction. His name is synonymous with indirect tax in India. He's the head of indirect tax for Deloitte. And over the years, he has assisted a wide range of clients across the spectrum, all indirect taxes, and he was in the industry as well, and he brings the unique blend of consulting and industry experience. We have Bhavna Doshi. She is again another big name in this indirect tax field. She is specialized in the field of indirect taxation for last 30 years, and she is also implemented value-added tax projects for various states like Rajasthan, etc. And also that she was working with the International Funding Agency on VAT projects. She is actively participating in the Indian GST initiative. She is the past president of the Indian Merchants Chamber and has several government and regulatory committee she is representing. And she was also closely associated with the the Institute of Chartered Accountants. And we have the other panelist is Bela. Bela is also another doyen in this tax field, not only in direct tax, even direct tax field also. She is alumnus of Indian IRS. She was she was a policeman in tax. And her professional experience includes working with the government as a tax officer, with KPMG as a tax consultant, then with industry as a business tax advisor. She is a member of Direct and Indirect Tax Committee of Indian Trade Organization and actively involved in advocacy initiative with the government on dispute resolution, GST, and various other issues impacting business in India. She is presently employed with Shell India as the country tax lead for South India, with Shell India as of now. Rohan Shah, I don't know whether I have to introduce him because people will introduce him to everybody, is a household name for all tax experts. He is now a practicing tax counsel in Bombay High Court and Supreme Court. Earlier, he was the managing partner of economic law practice and law firm established by him in India. He has been rated as amongst the leading tax lawyers by several international publications. India Today in January 2000 edition included him in listing of 50 leading Indians in the next millennium. So his expertise is going beyond tax. So I am sure that you are waiting to hear all of this luminaries here sitting in this dais. Invite next Prashant Deshpande to talk on the registrations and transition provisions.
Shining also.
Unless that can the laptop be
We'll
pushed
shift
here?
laptop here later.
If
It's
it
okay for
comes
me.
here,
Just turn it on a little bit.
so it's easier, no?
Good afternoon, friends. Thank you, Sachin. Thanks, Satya. Satya and I actually, had a harrowing time today to reach here. Just made it somehow. But while the fog and other elements in Delhi play truant on us, there is no less truant being played by the government also, as we can see here. I am going to talk about something which actually is a reality now, the registration processes. All of you know that registration processes have started from 6th of November, and in the first lot, they are completing the registration of the VAT registered dealers. The understanding is that all those who are registered for VAT will also be registered for excise, so they don't have a schedule for excise registered dealers. So VAT registered dealers are going to be enrolled by December end, and then from January, you will have service tax registered assessees also migrating to the GSTN. But one good thing about it is, all of those question marks that we always had, whether this huge portal that the government is setting up, which is quite a challenging task because it's one of its unique in the whole world. But we were wondering whether it's going to really work. But we can happily say that now that the first module of registration is working very well. So that's one kudos to the government. That first, off the block is a very good initiative or very good progress that they have made. So what do we have? What do we mean by registration? Satya covered it in brief in his address, saying that you have to take registration in each of the state. What does it mean? It means that wherever you have a place of business, you will be registered, and that registration creates a distinct person in the eyes of the GST law. So a supply between that person and another person registered in other state is a supply, taxable supply, notwithstanding the fact that the entities may be the same. And he has given certain examples. I don't need to repeat that, but registration in different states in the manner that it is envisaged by the law is the biggest challenge that we are going to face in future as we go along. Not the obtaining of the registration, but the managing the compliances for the registration that have been obtained and making sure that you discharge the taxes on in those registrations accurately and correctly. So what are the registrations that you have to take? Many misconceptions were there earlier. People said that, okay, you need to take one registration, you need to take two registrations, or you need to take three registrations. Happily, last year when the registration returns and refund, etc., payment mechanism rules were announced, it was clear to everybody that it's going to be a single registration, one single registration number in a state, which will be used for both CGST, SGST, and IGST. So that same registration number will be your identity of the existence in that state, and all that you need to do is, if you have more than one place of business, then you have to add in that registration those places of business as additional place of business. So who are the people who are liable to take registration? I think one of the biggest challenge is understanding who are people liable to take registration, because even the way the definitions in the current existing regime are spelled out, that is a VAT, for example, a person who is engaged in the business, in the course of business or carrying on business, those concepts are not there. There is a supply which is made, a taxable supply which is made, and a person who is making a taxable supply has to take registration. So to that extent, simplification. But there are some thresholds. Lot of discussion has happened over the years on these thresholds. We have currently in excise a very high threshold of 1.5 crores, and the VAT thresholds in some of the states is as low as 5 lakhs. So they have discussed and arrived at a golden mean, I would say, of 20 lakhs for registration. And in special category states, the registration threshold is even lower. What does it mean? If I have crossed 20 lakhs turnover or taxable supplies across India anywhere, then I need to take registration wherever I have a place of business. A lot of people have not understood this aspect, I think. Because 20 lakhs, today we had a 5 lakhs in a state. 5 lakhs was per state, 20 lakhs is across India. So if you cross that, then you need to take registration. That is the threshold of turnover. And special category states is 10 lakhs. So I don't know how it's going to work. 10 lakhs, if you have crossed in special category states, then you only register there and not in the other states. Maybe this is something that we can discuss further. If you are between 10 and 20 lakhs, but you have presence in those special category states, then what do? You only take registration there, you don't take registration in other states. If you have crossed 20 lakhs across India, then you take registration in every state that you have a place of business in. There are mandatory classes of registrations for certain class of persons, and we will get into that in a little more detail. There are certain events which have been held to make you liable for registration, and of course, if anybody is falling below the threshold of registration yet wants to obtain a voluntary registration, he is permitted to do so. So this is the standard turnover limit of 20 lakhs and 10 lakhs, as I said. The certain events are the transferee or the successor in case of a transfer of business on a going concern basis, or in case of or a person who is a transferee in case of a amalgamation. And the voluntary registration is very clear. Now, one aspect, if you know that there is change in the revised model GST law as compared to the model law that was put out by the government in 2016 June. Now in November 2016 they have put out a revised model law. One change that you may have noticed is earlier a supply by a job worker was not deemed to be a supply. Now a job worker making a supply is also going to be a taxable supply after completion of job worker, only when he makes it on behalf of the principal, and then the value of such goods that he manufactures on behalf of the principal are not to be included in his turnover for the, even for the purpose of recognizing the threshold. Now, continuing on the same thing, who is required to obtain registration? There are, I said mandatory registration is required. Now, there are many classes of people who are required to register mandatorily. Firstly, a person who is making interstate supply, whether he's crossed a threshold or not, is required to register mandatorily. Persons who are required to pay tax under reverse charge, required to, again without a threshold, required to obtain mandatory registration. Electronic commerce operator, required to obtain a registration separately. Persons who supply goods or services on behalf of other registered taxable person as an agent, they are also required to obtain registration, and there again no threshold. Person who is required to deduct tax under section 46 of the model law, and these provisions, as you may know, deal with deduction of taxes by certain government entities and PSUs. Person who is required to collect the tax under section 56, and this also covers electronic commerce operators. Input service distributor, we have this input service distributor provisions copied in the model GST law. The input service distributors have to obtain registration. The only difference is that input service distributor will not be migrated in the registration process. They will have to obtain the registration separately. Rest of the people who are taking registration enrollment, who are doing, are getting migrated into the registration process. They get a intimation from the VAT department. They get a username, password, etc. But for input service distributor, you will, whenever that is the registration for service tax assess is open, you will need to take a separate steps for getting registered. A casual taxable person is also liable to be registered, and so is a non-resident taxable person. But funnily, I mean, all this time we know that you have to obtain registration within 1 month of the registration. Funnily, casual taxable person and a non-resident taxable person have to obtain registration at least 5 days before commencing business. I don't know why such a provision has come, but how are you going to make casual taxable person, he occasionally supplies goods, right? Whether he would even know whether he's 5 days before that he is going to occasionally supply goods or services, yet he is required to take registration 5 days before commencing business. Let's see how actually it is to be dealt with. As regards non-resident taxable person, also same requirement is there, and you may have seen recently the provision of the OIDAR services, online information database access and retrieval services, which have been made applicable even in the current service tax law, also requires the non-resident person who is supplying those services to obtain registration. And this is in line with this OECD draft which has been placed earlier, where the B2C tax services were desired to be taxable. And I think, I may be wrong, but India is one of the few countries who have actually implemented it. And as we are seeing, I mean, since yesterday the portals have opened for registering the online information database, those services, and some hitches are there in that. Until yesterday the page was not opening, etc. But let's not deal with that now. GST registration is going to be possible for those people if you have looked at the current GST portals that have gone live. So, and the last category of persons are the persons who are required to pay tax under section 8.4. These are going to be specified categories of services. We don't know what those categories of services are going to be, but those are specified categories of services where the liability will be by virtue of reverse charge again. And persons who supply goods or services other than services under 8.4 through electronic commerce operator, which means if I have supplied goods to an electronic commerce operator, then notwithstanding whether I have crossed my threshold, I will have to register because he is going to pay, deduct the tax. Because he is going to collect the tax on my supplies to him and deduct it. So I have got to register whether I have crossed the threshold or not. So while registration seems simple, there are so many mandatory requirements of registration that one has to keep into account, take into account. And some of them are quite, as I have said, quite curiously worded also. Structure of GST, and I don't think we'll spend too much time, but everybody knows it's a PAN-based registration. If you are a person who is deducting tax or collecting tax, it's going to be TAN number-based. That's the only change. Otherwise, this is the structure. You have PAN, 11-digit PAN, 10-digit PAN, and then entity code. There is a one digit which has been kept blank, and there is a check digit, which is the sum total of the other digits. I think this is one of the most important thing that one should look at. When you can obtain registration, if you are a large business having diversified, large entity having diversified business, you can obtain a registration for business vertical. That's what the law which was released in June said. But what was a business vertical was not clearly known. So they have now provided a definition of what amounts to a business vertical. And the definition seems to be broad enough. If there is any discussion required on this, we can have a discussion. But any person who is going to be able to register his business verticals is one who is engaged in supplying in a product or a group of related products or services that are subject to risk and returns that are different from those of the other business verticals. So some concepts, Rakesh, from transfer pricing that have been brought into here, risk and returns that are different. You have to determine that whether I can register. First criteria is, are the risk and return of the business different from those of other business activities? And then for determining that, whether they are related products or services, you have to go into those 5 categories of you have to see any one of the 5 can be satisfied. It's not all of the 5, but any one of the 5 can be satisfied to be able to register as a business vertical. Now, this is a very simple chart which says that what is the registration process. Thankfully, only those, in this chart only 4 items a new registrant has to do, only 4 steps to get registered. Even lesser when you are existing VAT or a service tax registrant. So this process, and I believe some of your organizations may have already taken these steps, and you may already advise somebody to take these steps. And I have not come across any glitches here. But if there are any observations, please feel free to discuss. With that, I think I will, I've been told my time is out, so I'll skip any further discussion. So back to you, Sachin.
Thank you, Prashant, for an enlightening session. Now, I would request Bhavna to change that. Bhavna to take up this main, very important portion of what supply and the tax base, what is exclusion, exemptions, etc.
Thank you, Sachin, and good evening to you all. It's very hard to pay attention at this time of the hour when whole day you had so many sessions. But let's get on with it. My subject is tax base, and so far as tax base is concerned, for India, we are moving to a completely new concept of supply. So we are moving towards international concept and moving away from the concept which we have so far been used to, whether it's manufacture, sale, or provision of services. Similarly, when we look at global or international jurisprudence, what we find is that internationally there are really 3 bases, or the bases are divided into 3 parts. You have taxable, you have out of scope, and you have exempted. These are the supplies that you find. So far as we are concerned, we have taxable, of course, with 0 rating. Outside the scope, if we really see the alcohol for human consumption, that is clearly outside the scope. And as Satya mentioned, electricity is outside the scope, and real property, so where you have some immovable property which has come into existence, that would not be subjected to GST. So these are clearly outside. Then we come to petroleum products, which are partly outside and or temporarily outside the scope, excluded currently, may come in little later. And then we have the category of what is clearly excluded from the scope. Now, whether we can consider these excluded as similar to outside the scope, we'll have to discuss that. And then we will also have exemptions. We will also have something which is nil rated. So that would be a new category which we would have primarily from ITC perspective. When we move to the meaning of the term supply, now we have kept more or less to the international concept that supply includes. Some countries use the term supply means, but when we read the commentary and when we read the judgments, what we find is effectively means and includes are similar. So essentially all forms of supplies, and even where we have the term means, it's the same, and also where we have the term includes, it's the same. So it's all forms of supply which would include the sale, transfer, leasing, and so on. The major change, so far as India is concerned, is the barter transactions. Today, barter under our VAT law is not subjected to tax, whereas now under GST we have very clearly, because we are moving to the term supply, and supply is sort of, when we look at goods, is more or less means giving away possession. So change of possession from one person to another. So barter will now be liable to GST. It must be for consideration, and it should be in the course or furtherance of business. And when we look at that in the context of import, now so far as import of services is concerned, that is also supply. It must be for consideration. But the difference here is that even if it is not in the course of business, it will be taxable. So say, for example, I as an individual am doing up a house, and I take services of an interior designer globally, and I'm paying that person, even if it is not in the course or furtherance of my business, effectively it is supply. We may have exemptions later which could come in, or some basic threshold which could come in. Today it is not there. We also have certain services, certain supplies, which even if they are supplied without consideration, would be regarded as supply, so then they would become taxable. And here we have one item which is transfer of business assets. It is distinct from transfer of business as a whole as a going concern. So far as that is concerned, it is, the law is silent. So there is no specific provision either way, including or excluding it. Globally and generally, I mean conceptually also, transfer of business as a whole as a going concern should not be treated as a supply. It should not be subjected to GST, because it's just transferring from one person to another, the business goes on. So therefore there should be no tax on it. Otherwise you just pay tax and immediately take input tax credit. So it is not taxed. So hopefully we will also have it as not taxed. But since there is no specific provision, we could have some litigation on that. But if there are business assets, not the business as a whole, but some assets are transferred and there is no consideration. So say you transferred from one entity to another, say you've gifted, there is no consideration for it. Yet, to the extent you have taken input tax credit on it, if you have taken input tax credit, it would be treated as a supply. So you will have charge on output side. Also, as Satya mentioned, when you have different registrations, these are treated as distinct persons, and any transactions between the two will be regarded as supply, and therefore we will have the valuation issues which will come up there. Transactions between agent and principal is supply. Another aspect which was there in the earlier law, that if there is any free supply, supply for which there is no charge, it was regarded as supply. And there was double whammy, because input tax credit reversal was also provided for. So now that is corrected in the new draft. So anything which is a free supply will not be treated as supply, but ITC will continue, reversal will continue on that. Then we have some of them which are excluded from scope. So when you go to the definition of the term supply, it says that these are the certain list of items, supplies, which would neither be considered as supply of goods nor services. So in a sense, we could say exclusion or outside the scope of taxation. This is what is the service which are provided by an employee to an employer and variety of other services. The only point to note here is that the funeral, burial, and this type of services, including transportation of the body, would be now excluded from the scope, so it is not exempt. Coming to the other exclusions, variety of services that are provided by government are excluded, but there again, some of the services where government is providing those which are in a sense competing with other service providers, they would not be excluded. So postage, for example, even if it is between two government departments, if they pay for postage, that would be chargeable, that would be treated as supply, so that is not excluded. Similarly, transportation of goods, passengers, not in the excluded scope. Some of the services which government provides, and people were asking question that when we pay for patent or trademark registration, the fee that we pay to government, would it be liable to GST or not? Now that would probably be covered in the exclusion, that it is a service which is for registration, which is required under the law. And the question which was coming up is that is it really required? Is it mandatory for me to register my trademark or patent? Perhaps answer is no, it's not mandatory. But if you want to enforce it, you will need to go for registration, and therefore one could say that it is required for, registration is required for the time being, for the law enforced for the time being. Healthcare services provided by government are excluded. Again, it's very broadly worded to say that yes, all the diagnostic and variety of other services will be excluded, in the sense will be treated as healthcare services, including transportation of patients from one place to another. And this becomes very relevant, and I am aware of the institutions who were making representation, because there are several places where the cancer patients, because the hospitals don't have place, they stay away outside at different locations and they have to be transported. So that would be excluded. Here they've said plastic surgery and things like that will not be treated as excluded unless it is for corrective surgery because of some accident or injury. So one will have to really get into the details of that. Education, preschool, higher secondary, vocational, even those which are provided by boards, which have 90% controlled by government, set up under Acts of Parliament, and all of them will be outside the scope. Then when we come to its supply of goods and services, so the way the goods are defined, and again that has undergone a significant change in the revised law based on several representations that have been made. So when we come to the meaning of goods, first of all, actionable claim earlier was excluded from the meaning of goods, now actionable, and it was included in services. Now from services it is excluded and brought in as goods. Again, this was the whole financial sector was saying that you need to look at this, you can't tax actionable claims. Government said, no, we want to tax lottery and some of those items, so we'll have to find a way of dealing with it. So now they have included it in goods. Securities was included in goods, that has been now excluded. So securities transactions will now not be subjected to GST. But the major change is relating to the intangible property. Earlier, intangible was excluded from the meaning of goods, and we had definition of tangible and intangible, and it was making life very simpler, because anything which you can touch and feel was tangible, anything you can't touch and feel was intangible. The distinction was very clear and would have helped a lot, but now again they've gone back and they've said, no, we don't know, we are not very clear how to deal with intangible property, so we are not excluding it from the definition. And so far as services are concerned, the intangible property and actionable claim have been now removed. That issue open to be resolved by the law ministry, but as of now, all of those will be services. Whatever was declared service continues to be service itself. So far as intangibles are concerned, now again we'll have this challenge, and somewhere they've also noted that so far as intangible property is concerned, it could be goods. And similarly, when you have the intellectual property right transfer, temporary and permanent, which was hugely litigated currently, that litigation will continue. So if it is permanent transfer, it would still be regarded as goods, though not so separately specified. If it is temporary, it would be service. Similarly, for software, probably the shrink-wrapped or packaged software will continue to be goods, customized will be services. There are some other provisions. One is relating to job work, to which Prashant touched upon. Now, earlier job work, and that was perhaps a little error on their part, that said the job worker will be neither treated as supplier of goods or services. And the question was arising that what about the services which they bill to the principal? Whatever principal has supplied is fine. You ignore that. But what about the services which they are providing, some goods which they have added? And that is where the job workers were saying that in that case, are we losing out on anything? So now it is a special provision has been made, a whole section 43A, which has been modified and reworked to some extent. Online service provider is a new category which Prashant just spoke about. Now there again, and this is what Europe has already introduced, and they have a simplified, what they call as one-stop shop scheme, which is also being introduced here, and we have the concept they have used is simplified registration scheme. So perhaps they will have the option, which the rules will come, they'll have option to register only in one of the states, or they can have an agent or what is called as a fiscal agent in international terminology. Perhaps they will have to, if they don't have presence, they'll have to appoint someone to the extent they are providing services to a person who's using it for non-business purpose. And there, the person should be located in taxable territory. This will have to really see what are the challenges coming up on this. Electronic commerce operator, again, they will have to register. Which categories will have to register will be provided for. At the moment, what they have in mind are these taxi aggregators. Some more will come in because there are several such service providers. And with that, finish.
Thank you. Thank you, Bhavna.
Yeah, it helps.
So,
should we change you want to comment?
yeah, next is mine. So this session I would talk about the place of supply. It's one of the most contentious subject in the GST draft. And why is it important is that one should understand this clearly before you are interpreting the law and place of supply. So, sorry for that. So why is it important is that supposing you got it wrong and you deposit the tax, the GST in a wrong different state, the state which actually is the claimant for this tax collected is not going to leave you. So they will come back to you and ask for paying that along with interest and penalty. And the place where you have wrongly paid, you have to apply separately for a refund. One of the assumptions for any refund claim which you are lodging is that you have to prove that you have not passed on that to the customer. So there is no unjust enrichment. So that will take another few years before you're getting the money back. So therefore, it is necessary for us to understand that which is the location of the supplier of service and which is the location of the recipient of service. Now, GST being a destination-based consumption tax, it is important to understand clearly that which is the destination. That is most important, but it is fairly simple. What is more confusing could be that what is the location of supplier of service. Now, if you look at the place of supply rules, the entire place of supply rules are talking about what is the destination where you have supplied the service. It's what it's talking about. The area where we are getting confused is which is the place of supply, from where the supplier supplied the service. So it says that the supply from a registered place of business will be the location of that registered premise or the place of business. And if it is unregistered, supposing you have an office in Mumbai, which is registered, and you have a contract, but the supply is happening from Gujarat, which is a site office of your business, which is a fixed establishment, which is not registered. Then the place of supply, it is saying that it will be the location of such place or establishment. So it can be a situation where you have not registered in that particular state, but you have a fixed establishment there, which is not registered. Then the place of supply will be, depending upon from where you supply the service, it would be that particular place. So if the supply value exceeds the threshold limit, then you have to get registered in that particular state as well. Now, this confusion is there in when you are going through this, we'll understand that how important the location of supplier of service when you are deciphering or deciding that what is the nature of transaction. And in case if you don't have a place of business, you don't have a fixed establishment, then the place of supply of the person could be the place of residence. It's the usual place of residence. And nobody will say that I don't have a residence. So you will have a place of residence where it's considered to be the supply is provided. And the location of recipient of service definition is nothing but a mirror image of what is the supplier of service. If supply is received at a registered place of business, then the location of such registered premise, registered place. If it is other than an registered premise, unregistered fixed establishment, then that is the location where the service is received. Now, you know that GST is a destination-based consumption tax, which means that end of the day, the tax has to go to the consuming state. Now, there is a definition, who's a recipient? When you are saying location of recipient of service or location of recipient of goods, the question is that what is the definition of recipient? Supposing, especially this gain credence when you have a situation where you are ordering a particular item from a seller and you are asking him to deliver to a third party. It is a sold to ship to model. So here, as per the definition, the recipient of service or goods is the person who is contractually liable to pay for the consideration. So for example, A in Maharashtra place an order B in Bangalore as a contract. So contractually B is liable to pay the consideration, whereas the underlying goods or service is supplied to C in Gujarat. So the point of consumption, destination of consumption is Gujarat, but the definition of recipient say that the supply is made to the person whom the service are person liable to pay for the consideration. So those who are liable to pay the consideration, which means that your invoice will say that from Maharashtra to Karnataka is a IGST transaction, and you will charge IGST and deposit that in the respectively and mention that in the return respectively. Now the question is, how can that be a destination-based consumption tax? Because the destination of the goods is Gujarat. So it also presupposes that when there is a supply is made as far as goods are concerned, the supply deemed to have been made to the person who was contractually liable to pay the tax, pay the consideration. And in turn, that person has deemed to have made a supply to the Gujarat, whether it is his own stock point or a branch or to a third party. And therefore, even there is with consideration, without consideration, he will be paying GST on the taxable value. and take the credit of IGST paid in the first sale and set off that against the final liability. So ultimately we are saying that it is still meeting the criteria of destination-based consumption tax. Now, as regards place of supply of goods and services, there is the default rule, which means that whichever exceptions, other than the exception provided in the Act, the place of supply of goods and place of supply of goods of services are decided based on a basic rule. And the basic default rule is that the place where the movement of goods terminate is the, for delivery to the recipient, would be the place where the supply is made. And if the goods are need not move, then the place where at the time of delivery, where is the goods located is the place of supply. Which means that if I am selling goods to somebody or supplying goods to somebody, the goods are terminated, is dispatched from Maharashtra to say Bangalore, and it is terminated in Bangalore, so the place of supply of goods is Bangalore. Supposing the goods are lying in a factory, he is not taking delivery, he said that you sell it now, I pick up later. Then at the time of delivery, the goods was in Maharashtra and the sale is concluded. In that case, the location of the goods at the time of delivery would decide whether it is a local transaction or interstate transaction. So this bring into that build to ship to model, I already explained that to you. As far as service is concerned, where is the place where the service recipient is located? And if the recipient is not registered, then the address on record of the recipient. And if that is also not available, then the location of the supplier. So you don't know where it's an electronic transaction and you don't know which is the location. In that case, the place of supply is the place of the supplier of service. Now, what they have done was, in the amended rule, they have divided the place of supply of services rules into two. One is the supplier and the recipient both are located in India. Second is, one of the party, either the supplier or the recipient, is located outside India. The rules are different for these two categories. So for local transaction and international transaction, the place of supply of services rules are different. So in the case of international transaction, it says location of the recipient of service is the place of supply. So if the recipient of service is located outside India, then it is an export transaction. It is not taxable. And if the location of the recipient is not available, then location of the supplier. This is the rule. Now, there are exceptions to this rule, and these rules which perhaps you can relate to some of the business. It is talking about the exception on immobilized property. So this, what I talked about, the location of the service recipient or the place where the goods terminate is the default rule. There are exceptions to this rule, and one of the exceptions is immovable property related services, for example, works contract, lease. If you are hiring a hotel or lease, marriage hall, etc., is falling under immovable property related services. And when you say immovable property related services which are directly attributable to that immovable property, it says that whenever there is a supply of service in relation to immovable property, and if the immovable property is in India, in the case where both the parties are in India, the location of the immovable property. So which means that if I have an office in Mumbai, I don't have an office in Goa, I go to Goa and stay in a hotel in Goa, in which case the place of supply is supposed to be the Goa, the hotel. So the recipient is located in the same place he is receiving the service, and the hotel is a mall property. So it could be a local transaction. And since it is a local invoice what you are getting when you are staying there, unless and until you have a registration in Goa, it may not be possible for you to avail the credit. Because if you get an invoice of local tax of a hotel bill issued from a hotel in Goa, and you come to Maharashtra and you cannot take the credit because the money is deposited with the Goa government. And it is not a GST transaction, and therefore you may not get the credit. So the question is that whether we can argue that when I am giving the name of the stay of the person, if you are giving the name of an individual, he may not be having a GST registration number, so you don't get the credit. So perhaps you may have to give the office name, the booking should be in the name of office and in the name of, and give the GST and GST registration number. There could be possibility to argue that this is a interstate supply. When valuation comes, I think Rohan will talk about it a little more in detail. Now, and the second part of the rule is that if immobilized property is located outside India, so I am planning my vacation in the Europe, I approach Thomas Cook in India, and they are booking the entire itinerary hotel, including the hotel stay. So I am the service recipient, service provider is Thomas Cook India, both are located within India, whereas the hotel what Thomas Cook booked is outside India. In that case, the place of supply is saying that it is location of the recipient, which means that even if it is, you have enjoyed this property or you stayed in a hotel in London, and you, as long as the payment is made to this tour operator, you end up paying tax here. Supposing I decide that I am not going to book with Thomas Cook, I am booking with Expedia, which is not present in India, for example. There is a transaction where one party is outside India. So in that case, the rules say that location of more property is the place of supply, which means that I don't have to pay service tax. I'm sorry, GST. So this is a kind of maybe a misnomer in this law, and same thing is happening in the case of an event is held. If we approach a local organizer, maybe a Weissman or whoever organizing events for a FIFA event in Singapore, then you end up paying tax on the entire consideration as per this law. But if it is an outside agency, you may end up not paying GST. So these are some of the exceptions. Again, the transportation of goods and courier mail, etc. Both the parties are in India, which means that you are an exporter and you approached maybe all cargo logistics in India to book for the freight. And they are registered, it say that the location of the place of supply of service could be the location of recipient of service. And location of recipient of service, even if an export cargo, it's me who I have booked the cargo with all cargo, which means that even the export transaction, the freight that is booked become taxable in India. Supposing I say that, and even in the case of unregistered guy, if an individual is doing that, then the place where the cargo is handed over, doesn't matter, it is going out. And similarly, in the case of transportation, if it is on the other way, if we are booking that with a transport service provider or freight service provider outside India, then it is saying that the place of supply is the destination of the goods, which means that I don't have to pay GST. You can say that GST, once it is paid, you may get the refund for export, or maybe you can get the credit of it, but there is a cost attached to it. So it is better for me to tell my customer or a buyer to book those transportation or a freight in outside India so that I don't pay. So this is a misnomer in this rule, may not be meant, but this is what is it. And this is the same thing in the case of passenger transportation as well. The place where the passenger embarks for a continuous journey, or location of recipient if it is a registered scenario. So these are some of those distortions in the entire thing. And coming to the telecommunication space, the place of supply and broadcasting, the place of supply is again very confusing. It says that where the place where the medium of communication is installed. For example, if I am having a DTH or a cable TV connection, then my place of supply is the place where this equipments or the cable is installed. So the question is that from where it is provided, it is the place where it is consumed is what they are talking about, the place of supply rules. So whether it is the place where the uplinking is happening or the place where the broadcaster's office is located, the uplinking will be through a third party. So depending upon that, one need to say that, one need to decide that whether it is interstate transaction or a local transaction. And similarly, in the case of lease circuit services and fixed line communication, it's the place where the instrument is installed, is the place of supply. Again, coming to the banking services, it's the location of the service recipient on the record of the service provider, or the location of the service provider. This is in the case of insurance and banking scenario. There cannot be an export of service because it is all depend upon the on the record. What is the name of, what is the address, location of the account holder, irrespective of whatever transaction, that would be the place of supply. Whereas in case one of the parties located outside India, the location of the service provider would decide that which is the place of supply. And again, the online database access or retrieval services, again, now they've amended the current service tax law, and that is brought in here also. Now, even though the service provider, this is because the Indian service providers are disadvantaged against a Google or somebody who is providing the database online access to an Indian customer, because the Indian customer would be a B2C scenario, and he is not liable to register or neither having a reverse tax liability because he is a consumer, unregistered consumer. And therefore, those kind of downloads never attract tax, whereas if it is done within India, the service provider would recover the tax. So this is a leveling scenario. So this is what is the gist of the place of supply rules. And this is very important for anybody to understand that, because without which we may get into a scenario where you pay the tax wrongly or you may not pay the tax for that matter. So thank you. I would request Bela to take up the input tax.
I don't know, can you move? Okay, so before I start, I must acknowledge I'm honored to be here among indirect tax stalwarts. I have done direct tax primarily all my life, and these are my baby steps into indirect tax. Yeah, so I cannot be in the same league as all my co-panelists for sure. But it is a good time to start doing a new tax, I think, and it's something that a lot of you who are doing direct tax should consider doing. Yeah, and that's, you know, it's a good time to be in this space. So. So yeah, let's go to input tax credits. Now, you know, for me, this is the backbone of GST. Yeah, you know, the whole reason why we have a GST and we said we have one tax is to ensure that the input tax credit flows through and through, right? Today we had cascading of taxes, and therefore the whole purpose of bringing, the key purpose of bringing in GST was to say that in the value chain, the taxes should not get stranded. You know, there are, so more or less that purpose is getting achieved, but of course there are distortions, as you've seen across all the other topics, that it's obviously not an ideal GST. There is a lot of, you know, places where things could get better. And to begin, so beginning with just the concept of input tax credit, you have three types of taxes under GST: IGST, SGST, CGST. Now there's a hierarchy as to what taxes can get credited, you know, at what point, and then what tax gets credited against which other tax. So there's already a hierarchy built in, so it's not as simple to say whatever tax you pay, you'll get credit for it. It's that simplicity is not there. The end result of all this is that CGST and SGST are not creditable. That's the end result, and there is a hierarchy for all other credits. I don't want to go into detail. So from that principle itself, there are certain, you know, maybe step outs or distortions that are getting built into the input tax credit mechanism. But there have been a lot of changes and improvements in the recent law that was announced, the model draft law that was announced last week. Primarily now input tax credit is available across the value chain except for certain kinds of supplies like for personal use, and for certain kinds of products, the ones that, you know, Bhavna referred to, the excluded products, or you know, products which are outside the scope of GST, which I'll come to separately. Otherwise, for all the goods that are within GST, yes, you will be allowed input tax credit subject to that hierarchy and subject to fungibility among taxes. Another key feature of GST, and which, you know, for a lot of us who are in the industry is important, is it's a self-checking mechanism. People who've done direct tax, TDS, it works exactly like withholding tax works. The person who has withheld your tax, unless he has uploaded and paid the tax and filed the tax return, you will not get credit, yeah? As simple as your employer, yeah? Your employer, your salary taxes, if they are not withheld, if they are withheld and not paid, you don't get credit for it. Exactly the same principles have been put in, but at a much more larger scale, right? You're talking about every transaction now, where this needs to get done. And so the way I look at it, it's self-checking mechanism is your vendor, the person, your supplier from whom you buy. He has to issue you the invoice in time. You have to make the payment to him in time. He has to pay those taxes in time, and then he has to upload all those transactions within the time period. If all that happens within time, only then will you get credit of the tax that you've paid him. So again, that mechanism is very strict. If all this is not happened within the time that's laid down, you will not get the credit. And therefore, from an industry perspective, for me, the way I look at it is, you know, you may get your GST as right as you want, but if your supplier doesn't get it right, your GST, it doesn't matter what you do with yourself. So your backend has to get it right. Your backend means people who supply to you, your vendors. If they are not GST compliant, you will not get any credit, even if you've paid him in time. And that is a crucial feature of this GST. It's a self-checking mechanism to say everyone in the supply chain checks to see whether everybody else is behaving well or not. Because if somebody doesn't behave well, the credit chain immediately gets broken. And also that there is a very limited or restricted period for you to get the credit back. Yeah, to avail any missed credits, you have a 1-year period, but with a timeline of 30th September of the following fiscal year. Right? So for transactions that happen after 30th September, that 1-year period will keep on getting lesser. And after that 1-year period, as per the law, there is no mechanism to avail lost credit. Right? So you will lose out that key credit. And that is a big loss. So input tax credit, the provisions are clear. There isn't that much ambiguity as you've seen in other provisions, but they are very strict. They need to be followed, and everybody needs to behave well. Yeah, there is a compliance requirement that needs to go down all the way down the value chain. Otherwise, you know, the entire value chain will suffer further down. Yeah, and then we come. So this is, you know, the premise of input tax credits. But then we come to the excluded products. Yeah, the ones that Bhavna referred to. You have the real estate sector, as he said. There's, you know, the supply, the completed, finished, immovable property. When you sell it, it's outside GST. There's a stamp duty on it. The stamp duty is not included in GST. Where, you know, the power industry, electricity duty is outside GST. And there are 5 petroleum products which have deliberately been kept out of GST for now and may be brought in later. So what happens to those industries? Yeah, what clearly happens to those industries is that the input chain gets broken because your product that you are selling is outside GST. There's no GST being levied on it. So for example, you take power, all the materials that you will use to set up a power plant, to generate the power, the services you use, all that will suffer a GST. But the output, which is electricity, will not suffer a GST. So what happens is, even today there is some amount of a cost, but those costs will only go up because the rates of GST will go up. So the cascading in those industries is only going to go up. Similarly, if you come to the oil and gas industry where I come from and where I have done a lot of work, it's simple. The crude oil today, when you extract crude, there is no tax on it, but there's a lot of services that get into the crude, and there are some exemptions provided today under the Customs Act, under the Excise Act. There are lots of exemptions provided. Only there is service tax that is levied, but a lot of other taxes are exempt. Tomorrow under GST, everything that you require to extract crude will suffer a GST. There are no exemptions. There are no exclusions. And therefore, that cost of crude will go up because you will have your products and services which will come loaded with GST, but on crude there is no GST because it's out of GST. So from that starting point of supply chain in oil and gas, there is a cascading of taxes that will start. That crude, when it goes to a refinery, again in refinery you have, 10 products, 2 key products, petroleum and diesel are out of GST, 8 other products are in the GST. So whatever GST loaded products that come into refinery, you will have to reverse the credit for the products that are out of GST and take credit only for products that are in GST. So again, a second level of cascading starts there, right? And then when you sell that product will suffer a VAT and not a GST for today. So the cascading in the entire chain, there is a cascading today, but it's just going to go up because in certain cases cascading is going up, in certain cases the rates are going up. And therefore this input tax credit, and this is going to impact every industry that takes that as an input. So you will use electricity to manufacture goods, you use you use power, you use petrol, you use diesel. So every industry is going to get impacted because of this blockage of credit. And that is, that is something that is key to say that we all, the message that we are getting is input tax credit flows through and through, that there are certain areas where there are blockages, and that's an area for concern for the industry. Again, when we were discussing for the panel, the other issue was again about exports. Yeah, what happens to exports? So today, a lot of these export-oriented units or SEZs, when you set up, you supply to them, there are no taxes that are charged, right? Under GST, what they have said is, they'll get zero-rated, which means that you pay the taxes in the entire supply chain and you claim a refund of those taxes. Though they have said that, refunds will get back, and 90% refunds will be within 30 days. From all our collective experiences, I don't think we can believe that till we see that refund check in our hands, right? So that itself is it may not be an input tax credit blockage, but it clearly is a cash flow issue, a big one, because for industry, you first pay the tax and then you claim the refund. Yes, sorry. No, it's okay. So I think these were, and then of course there are certain, other areas where certain deferment of credit is allowed, like in case of pipelines, in case of telecom towers, where credit won't be allowed upfront. It will be deferral of credit, but it will still be allowed, which I understand was a key issue today. But tomorrow, at least, it's a betterment of the way it works today from what will work under GST. And again, on construction, as I've said, that towards the where it will be allowed. So if you look at on the right, the GST output supplies, if you are input supplies and there's output, there's a GST, then there'll be eligible credits. If they're exclusively used for GST taxable supply, then 100% credit. If they're not exclusively used, so there is, some of your output is not in GST, some of it is in GST, then you have to prorate it, which means there's some credit blockage that is there. But if you take GST supplied products and all your products are outside GST, so for example, the crude, the exploration industry, in that case, everything becomes a cost. Yeah, the entire credit gets blocked in that case, and there's no credit available in the chain. So clearly, there are some key distortions that are there in the input credit chain, which are there in the law, and it's unlikely that those will get sorted out by the time we come into implementation phase, because this decision is an informed decision of the government. They have taken it by choice to say we don't want to do it in a particular way, and therefore we don't expect any big solutions to this. I think we will have to deal with the cascading, and we'll have to see what kind of impact this cascading will really have on the final product prices. And the government was looking at a couple of options to try and see whether they can alleviate this cascading. But as of today, what we understand is that it's unlikely that any such solution is in sight. So we'll probably see a GST where all these products will be out, and it will lead to a cascading. So I think I'm done with my slides.
Thank you, Bela. Valuation, and appropriately we have requested Rohan to take up the subject. Back to Rohan.
Thank you.
Thank you. And to get to what ultimately might become the most contentious part in an already very seemingly contentious GST. So let's look at this. Essentially, any process of the levy of tax, you're going to define the taxable event, which is effectively supply, subject to exclusions. The rate of tax, where we have the 5-rate structure, and that's getting fine-tuned, so you may have higher rates of taxation in terms of slabs. And then you will have the measure of the tax to which that rate will apply, which essentially is covered by the provisions of valuation. Important to understand what is the nature of the migration that we are seeing. The nature of the migration that we are seeing is that you took 3 traditional concepts of taxation, namely the act of manufacture and clearance in excise, the act of rendition of service in service tax, the act of sale in VAT. And it is these 3 that you essentially are looking to subsume as taxable events into what you now have GST, and that GST is going to deal with the factor of supply. Now, as we looked at this, what should have been the measure of taxation? The measure of taxation that we've chosen in terms of section 15 of the model law is the transaction value. What is the antecedent of transaction value? You have transaction value in the context of excise, but even in the context of excise, it was inspired from the customs valuation. Now, customs valuation essentially would only deal with goods. From 1988, we've had an evolution of the law in terms of transaction value. Under customs valuation, it deals only with goods. But when you look at a GST and the fact that it will deal with both goods and services, the one factor that we all need to have some degree of concern on is you have now a tax on both goods and services, but the method of calculation of value is really drawn only from the realm of goods, whether it is in the context of excise or whether it is in the context of customs. So this is one important factor where you really have no precedent in terms of applying customs valuation or excise valuation type concepts to the factor of services. Now, if the value of taxable goods, which is supposed to be the transaction value, cannot be determined because there does not exist a transaction value, then quite similar to the scheme we just now have in excise and customs, you effectively move to an alternate provision, and that alternate provision takes you to a set of valuation rules. And again in GST, that set of valuation rules is the GST valuation rules. Now, you have certain specific inclusions in the concept of the transaction value itself. So all nature of taxes, duties, cesses, fees and charges which are levied under any statute except the GST itself, that means except the C, S and I GST, these will all be specific inclusions in the concept of transaction value, as long as it is this set of taxes is charged separately by the supplier to the recipient. So therefore, if you came to a situation where, let us say, there was a supply which was either without consideration or where this supply, although made, the taxes in question were not charged, you will always have the question as to whether that, in a manner, from the very description of this, remains excluded from the transaction value. Now, the amount which a supplier is liable to pay in relation to a supply, but has been incurred by the recipient and is not included in the price actually paid or payable, is also included. This really is inspired straight from what we used to know as Rule 91B4 in the context of customs valuation, or in the terms of free supplies that we had in the context of excise. So therefore, if you gave jigs, if you gave drawings, if you gave designs, these were considered to be expenses which ought to have been borne by the seller, but in relation to which the buyer effectively created a event whereby he alleviated or took away some of the expense which the seller should have had. So this, as I said, pretty much like Rule 91B4 or what we had in terms of the Rule 6 type scenario in excise, you have to pay. If you have an interest or late fee or penalty for delayed payments in terms of the contract for the supply of the goods, then effectively this is included in the transaction value. This does not include interest in the realm of banking transactions. It does not include penalties in the realm of statutory levies. It just includes either interest or penalties which are contractual penalties emanating from the same contract of supply. Subsidies directly linked to the price, excluding subsidies provided by the central and state government. So when we had the former formulation of the model law, which was the June formulation, there was this whole debate as to whether central and state government subsidies, whether investment linked or area based, whether those would also effectively suffer a tax, and if so, how would you compute those? Fortunately, in the latest iteration, which is the 16 November iteration, government subsidies, whether central or state, are taken away, but all other subsidies are effectively included. So you have the normal concept of price paid or payable, to which there are statutory inclusions of all other taxes other than the taxes for GST, the amounts where a buyer differs or pays the payments or bears the expenses that actually a seller should have, your interest and your late fee of penalty, and subsidies other than central and state. So these become essentially your mandatory inclusions. How do you treat discounts? We've had a long and checkered history in the context of discounts, starting with, some of you would recall in the context of excise, the Kelvinator judgment, then the Pepsi judgment, and then you came to the Fiat judgment. And all of them sort of took a view in terms of what discounts should actually be allowed or not allowed. Fiat was the distortion. But if you see the commonality that you had through all those judgments, part of that is reflected in this provision. So, if you know of a discount which is known before or at the time of supply, that will not be included in terms of the value. However, after the supply has been effected, if you have a discount, then that is likely to be included. You could seek the exclusion only if such discount is established in terms of the agreement entered into at or before the time of such supply. Second, it is specifically linked to the relevant invoice, so you need a nexus or correlation. And third, that the input tax credit proportionate to such discount is effectively reversed. So if you have discounts pre-supply, then you are going to get them. If you have them post-supply, you will only get them if these three conditions are established. Now, if you look back at excise and specifically Kelvinator, it said that you would have to give a discount in the context of three scenarios. It was pre-agreed, it was made available to everyone similarly placed, and it was actually passed on. So the situation that you now have is part of those elements have been brought in, and you have another element, which is to say that under section 154, it is in the discretion of both the central and the various state governments to notify certain trade discounts which they want to allow to be excluded from the value under section 15. Now, this is where they've been given a domain. It's a discretionary domain. It appears that there has to be no uniformity in terms of this, and therefore individual states, as the center, also has an ability to effectively say that I want to grant another species of discount as something which is not includable in the assessable value. In all other cases, discount will form part of the value of the supply of goods or services, and in a manner, as I said, consistent with the sort of jurisprudence that we've had from the Supreme Court on the issue of discounts. The other relevant concept and a very entrenched concept in the context of GST is consideration. So consideration under the model GST law covers both monetary and non-monetary consideration. Now, if you see what species of monetary and non-monetary and how they are to be dealt with, in a situation where you do not have a monetary consideration, that is a quantified price paid or payable, as I said, you will go to the GST valuation rules, and as you go to the GST valuation rules, you get certain alternatives of how to determine value if that transaction value doesn't exist. Now, in the GST valuation rules, when we had the formulation of the 16th of November, there are no changes made to what was the older version of the GST valuation rules. One understands that that is work in process, and effectively they will come through with some changes. But if you see the approach is very much what we draw from the customs valuation rules. So what is that approach? If you have a transaction value, that in every situation prevails over everything else. If you do not have a transaction value, or if the transaction value is such that you believe that a relationship between parties has influenced the price, then as in the customs valuation, qua these related party transactions, there is a presumption that the price is not the transaction value, but it's a rebuttable presumption. You can rebut it on evidence. What is that evidence? Under the customs valuation rules, you can apply two tests. One is a circumstance test, namely, you show that the circumstances of the sale were such that the price was uninfluenced by the relationship. In the circumstance test itself, you have an opportunity to provide what are called either test values or proxy values. Namely, you show that somebody else to whom those goods were sold, who is unrelated, got these goods at or about the same price as the transaction between the related parties. So the approach in terms of the customs is transaction value, but absent transaction value, you effectively go to a set of alternate rules. And within that, as far as related party transactions are concerned, the presumption that the rule makes can be rebutted either through circumstance or in terms of a proxy value. But the provisions which you have in customs, all of which are the rule 33A, 33B, etc., are completely missing. So while you adopted the law in terms of the overarching principle, we haven't taken the detailing of the law, and that is effectively certainly something which is going to create an issue. The value of supply, as I said, shall be the transaction value, where goods are transferred from one place of business to another place of the same business, and this is where the distinct persons concept will come in, and where goods are transferred from a principal to an agent or vice versa. So in a situation where there is a designated value, it will be the transaction value, it will be applied, but absent the transaction value, you will then have to look at alternate values of how you will try and establish this. And what we've done in this slide is try to benchmark the set of rules. So if you see on the left is the GST valuation approach, and on the right is the customs valuation approach. Now, in the determination of the value of supply, when you talk of comparison, the transaction value of goods or services of a like kind and quality supplied at or about the same time to a customer can be taken. If we look at this in the context of customs valuation, this is rule 4 and 5. That is the value of identical goods or the value of similar goods. A very difficult concept. This concept has been litigious from 1988. This concept continues to be litigious today, and we are dealing with, in customs, the simpler issue of the value of identical or similar goods. What is identical or similar? One approach to identical or similar has been, when you talk of identical, means it must be commercially and technically substitutable. Now, if you talk of commercially and substitutable goods, in customs valuation, you have dealt with certain issues which for years have engaged regulators all over the world. And let me give you two examples. If you have two 2000cc cars, which are luxury sedans, is a Mercedes identical goods to an Audi? Is a Mercedes identical to another 2000cc car, which is not of one of these premier so-called brands? Now, you won't be able to answer that because many people have tried and many people have, in a way, almost failed attempting. Let me give another example. Luckily, alcohol is out of the GST. But is one 12-year-old Scotch whiskey the same and identical to another 12-year-old Scotch whiskey? Is one dress of size 12 made by a designer similar to a dress of size 12 made by a non-designer? These are issues which have continued to vex us. They've vexed us in goods. Now try and imagine this in the context of services. Are the services of one audit firm identical to the services of another audit firm? And at the risk of losing many friends, I'll just say let's leave that issue open. But the question is, how is it that you find an alternate parameter? And how do you find an alternate parameter which is an accurate and non-litigious parameter? So this like and identical, especially in services, is going to be an absolute nightmare. Then we have the concept of computed, which is cost of production, plus normal markup within the industry. And I can see that all my friends who are doing transfer pricing no longer may remain transfer pricing lawyers. They pretty much will become GST lawyers. Because how is it that you're going to administer this as a concept? There is, in the customs law, a deductive value method, which is that you see the sale price in the context of an unrelated party sale, and you work yourself back by deducting local expenses, local taxes, etc., and then you get left with a value. Deductive is not a concept we've adopted in GST. So if we see this, we've taken a concept of goods and seek to apply it to goods and services. We don't borrow the whole concept because we've not taken Rule 33A. We've not taken deductive. We've taken residual. And one of the important measures in the context of the customs valuation is you apply alternate rules sequentially. So if you cannot find your value in Rule 3, you will go to Rule 4 identical, then to Rule 5 similar, and on your way through. Here, you effectively have these rules with no precedence of application. So if I claim that I fall under one rule, but the tax officer claims that he wants to compute under another rule, there is no primacy or hierarchy of rules which are given. The last issue, you have a residual method, and the residual method gives the officer elbow room to use any concept from the concepts which are articulated in the rules and say, I will apply it with some variation or the other. What that variation is, what is the extent of that variation, again in customs you've never found the answer. The last issue is rejection of the declared value. Rule 12 of customs has really become the nightmare of customs administration because the reasons for why a customs officer may launch an investigation to find an alternate value gives him such tremendous leeway that most people have said that Rule 12 has really been the undoing of customs valuation. Now, take the Rule 12 power and effectively invest this power into officers in the state. The risk that a state officer or a central officer may take divergent views on an interpretation of value, the risk that two states may take a divergent view on interpretation of value, and the risk that many of those who will administer have never administered in the context of service tax. So when you put all of this together, the situation that you're going to see is we've taken a law which is regarded world over as an integrous law, the customs valuation. But it's a law in a continuous phase of litigation even today, and it's a law which has never been applied in the context of services. Let's talk then about the valuation of self-supplies. At present, a supply of goods or services between related persons or distinct persons, you have a certain specification in section 10, should be liable. The distinct person situation, of course, comes, as was mentioned earlier, the same entity but with different registrations in different states. So when you make such a supply in the course of furtherance of business, even if made without consideration, then liable, and we need to look for the value. And today when you talk of in course of the furtherance of business, the situation is, as Supreme Court effectively said, in the Ballarpur Industries and other cases at that point in time, that no prudent businessman undertakes any activity which is not relevant for his business. So in Ballarpur and East India paper, Supreme Court said that every activity that a businessman undertakes is really relevant to his business. And therefore, anything which is done in the course of business is really capable of coming within this course of furtherance of business type scenario. But all of this will be treated as a supply, and this is a set of supplies on which the GST is leviable. So as far as we are concerned, the one situation that we will recurrently keep seeing is where goods are transferred from one place of business to another or of the same business, you will be liable. Transactions, therefore, not traditionally taxable will be taxable. The footprint of taxation has moved from events of manufacture, supply of service, sale to a much larger concept of supply. The measure of value is a measure which has only been tested in the context of goods, and you're now trying to apply that same measure in the context not only of goods, but also in the context of services. And therefore, that, from our perspective, is the sort of law that we are effectively seeking to bring in. Transaction value, as I've said, as defined under 15.1, can only apply where there is a monetary consideration for the supply. If transaction value can't be determined under 15.1, then we will go to the valuation rules, and the method that we will apply will either be supply by comparison, that is like or similar, computed value, or residual. No specific rule has been prescribed for valuation of interstate stock transfers or supply of services between distinct persons who are part of the same legal entity. So while there is an event of taxation, what rule will I effectively apply, or will this get subsumed in the rule of like and similar? But if it is like or similar, then what is like or similar to my business? If I'm a small and medium business, is such a transfer price for like goods or services of a large industry applicable? Is it applicable across different sectors? Is it applicable across different geographies? All of these are questions which are not answered at this point in time. So we do have a framework for the valuation, but I guess many people will say that the challenge really is that in the articulation we have a sense, but in the unarticulated we have the challenge.
Thank you, Rohan.
So much for a good and simple tax.
So we have, I think, 10 more minutes.
Yeah.
Yeah. So in this this very enlightening discussion, I just want to ask a question to you, Rohan, that this valuation rules, why is it required, except in cases where the final supply is to a B2C? If it is between a B2B scenario, some point in time the government is bound to get the revenue on the final value. So is it necessary for us to have the valuation rules as proposed in the length and breadth as it is today, as opposed to a very limited valuation rules which is applicable to a B2C transaction? Is it a fair question?
It's a very fair question, and obviously gets you to think that a lot of what we have, including the place of supply, including the sort of concept of valuation you have, is really a situation which reflects the federal structure we have. If ultimately we were able to trust the system to tax at the highest point of value at the actual point of retail consumption, without any anxieties of which state gets how much, then quite honestly, a lot of what we have as the formulation of the law might become unnecessary. And as I said, both valuation will become unnecessary, except in situations which are free supplies and you want to find an alternate or proxy value. But likewise, place of supply would become, also irrelevant. So given the structure we have, unfortunately, we will have not only the law, but what for me is a little more troublesome, we have a law which is quite difficult, and, some of the best brains in the country are sitting here trying to explain it to some of the best brains in the country. And it still seems to be a bit of a challenge. This challenge to me is really going to get augmented not in the nature of our law, but in the nature of our interpretation.
That's right. I think that's a fair point. I just want to ask you, Bhavna, the transfer of business as a going concern was always been, it's always settled law that it's not taxable because business is a confluence of so many things, which is service, goods, intangible property, mold property, all of them put together. Now, what is the status as of now? In the earlier law also there was no express provision, but yet it was not taxable. Will that hold good here also?
I believe so, because again, we have international experience that this is not taxed, sale of business as a whole as a going concern. We had some of the VAT laws which very categorically said that this is not liable to tax. The whole concept is that the business is going on, it's only the ownership which changes, and since the business is going on, and if you have to charge tax on it, then that same amount will have to be made available by way of input tax credit. So to avoid that charging of tax and giving credit, globally, the countries don't tax it, but we need a clear provision because having experienced the way our administrators look at this, they may try to tax it and then we will get into litigation as to whether it's taxable or not, is it, and also we have this whether it's sale of business assets, because from income tax purposes, we may have a lump sum a transaction for a lump sum price, but then for tax purposes, they might say that no, it needs to be treated as sale of business assets. So ideally, one would like a provision to avoid litigation.
In foreign jurisdictions where I've dealt with this topic before, a sale of business can take place in 2 or 3 different forms. In the case of a company, sale of a business takes place by selling the shares from one group of shareholders to the next group of shareholders. So that sale will be usually an exempt sale, because shares are a security. Even in the GST law, securities have been excluded from the definition of goods and services, and they'll be an exempt supply, there's no tax on it. In the case of an unincorporated entity, in the case of a partnership, sale of a partnership, share of a partnership interest. Partnership interest is also a security, equity interest in the partnership. Then you have an unincorporated business. In the case of unincorporated business, sale of the business could be a combination of assets, but in many cases, like an insurance broker, he has got no assets. All he has got is a mailing list of the customers. And that can be viewed as a sale of goodwill. So in many countries, when they want to not tax sale of a business as a going concern, they implement the law, they amend the law to say goodwill sale is not subject to tax. So the rule, this concept of not applying the tax on sale of business can be effected in a number of different ways. In my experience, there are very few countries where they'll have an explicit clause to say sale of a business as a going concern is not taxable.
Thank you, Satya. Bela, many people expressed concern over the last quarter of this year. People are afraid that this transition provision is good enough to address the concern of the trade and industry. What do you think from the industry perspective? Is the transition provision good enough to address the concerns, or what is your expectation on this?
So first is it's good that the transition provisions have now been brought in. There weren't any, till now. So now it's good to have it. But I think the concern that we see, at least in our value chains, and especially when you go to the smaller vendors, I think the concern is that one place there that you can claim the credit, provided you've passed on that price benefit, to your customers. So we are talking about transition provisions, which means as of the first, the last day of the old law and the first day of the new law, right? If you have stock from the last day and it's at a particular value, particular price, and then on the next day, you will get credit for some of those taxes under the new law, but you will now have to see whether you need to change your price to try and get that credit. And I think that is where the concern is, how will that work out? Again, it's uncharted territory, unexplored territory. This has never happened in the past. I mean, the whole anti-profiteering that they brought in is post-GST implementation. In the transition provision, they have brought in this concept, and really not clear how this is going to work. How will I, what will I need to prove to say, yes, I have passed it on, or anyways, I was bearing, I was selling my goods at a lower price. I was not passing on my taxes in the first place, so I do not need to do anything if I claim the credit. So there are all lots of unanswered questions because of that one condition, and because of which, my senses and when I speak to into the supply chain is, a lot of people have said, we will just stop buying products, last 1 or 2 months. Why do we want to get saddled with old stock? Or we will minimize that old stock to the maximum, so that we don't get saddled transition. So there is one school of thought that it could sort of really impact economic activity if there isn't any more clarity around, how will you pass on that credit? claiming the credit is okay if there's paperwork, but if I have not, how do
Yeah,
I
think that's
demonstrate?
Very fair point, because the provisions say that the transition provision of the stock which is held with the distributor, where they don't have a invoice to prove that tax excise duty is paid, is allowed subject to a condition. They have to notify that what is the terms and condition under which they will allow this, but there is a provision there. But it say that it also presupposes that you will be passing on, or you have to prove that you are passing on the credit which is available to the consumer. Again, this is going to be a big issue. Prashant, I have a question for you. You talked about registration and e-commerce operators who are supposed to be deducting the tax collected at source TCS need to register and collect the tax at the rate of 2% to 2.5% and deposit with the government. Supposing an e-commerce operator who is present only in Mumbai, having a platform, and that platform there are different people are trading. There are people from the same state, buyer and seller, different state, and all the 29 states there may be local sales and interstate sale, and I am deducting 2.5 from the total amount of traffic of the taxable value of the traffic. How do you expect that this will, how the people will meet with the condition that you have to get registered and deposit the tax?
Yeah. See, what is this act? What tax does this act levy? This act levies a tax which is called the Central Goods and Services Tax. It levies a tax which is called as the State Goods and Services Tax. It also levies a tax which is called the IGST, Integrated Goods and Services Tax. But somewhere in the act, they also have given the power for the government to specify the services on which electronic service operator shall levy a tax, section 8.4. So this tax, which is actually the fourth tax, it's neither a IGST, neither a CGST, nor a SGST. It's a fourth tax which is levied by the electronic commerce operator and by virtue of section 56 at the rate of whatever 1% or whatever they are now saying, which is going to be collected from the net value of net value of taxable supplies that are being made, and it is going to be collected by the electronic commerce operator and deposited into the electronic cash register of the seller. So it's neither a IGST nor a CGST. So whatever supplier has charged the IGST, CGST, depending upon from where he is going to supply the goods to the consumer, is going to be the liability which the supplier is going to discharge. The money is flowing through the electronic commerce operator. He is going to collect that 1% amount and deposit into the electronic cash ledger of the electronic cash register of the supplier. So if the and the provision is going ahead and saying that you have to declare what is the taxable value of supplies, and if there is a mismatch, then whatever is the excess amount that the electronic commerce operator has actually declared as a taxable value of supplies made by the supplier will be the liability of that supplier. So this is a kind of a provision which enables to keep a track of some supplier who may be below a threshold level, who may be supplying through the electronic commerce operator. They get the amount of credit of that whatever percent of tax is collected, and are able to utilize it through their electronic cash register for the payment of any tax, penalty, fees, etc.
Thank you. Just to supplement that, the issue is a little more severe. If an electronic commerce operator deduct tax 2.5%, the total turnover of this, that is divided into 29 pieces. 29 states, there will be local sales and there will be IGST sales. So it need to be captured separately by electronic commerce operator. And as per the today's law, you have to register in all 29 states and deposit the TCS separately. They have to capture it separately. Even to see the TCS return form, it talk about the place of supply and place of destination. And that is humongous. And I don't think anybody can achieve this in this GST era.
Can it not be like a TDS, transaction by transaction?
No, it is, but the identifying that which state it is to be deposited, because a local transaction, a CGST, ICGST available,
Because
is applicable. that cannot be transferred from a single account. If you're depositing in Maharashtra, the entire thing, it is not IGST account. So unless and until the government come out with an IGST suspense account like TCS account, supported by the return which gives the state-wise amount to be deposited, the electronic commerce operator is dead with the burden of compliance. So I just want to give us maybe another 5 minutes to the audience. If you have any questions, please. Yeah. You have a mic?
Check.
Yeah, so I think the new provision which is saying that SEZ will be zero rated.
With refund.
So when you say zero rated, we have to wait for the rules to say that which way they are going to do that. If it is zero rated, it is giving a status of export, and therefore there is a refund available for input, whatever. Either you have a ab initio exemption or there will be a refund available. So I think perhaps I would request Rohan to answer this.
Sir, for a lawyer of your eminence to even ask a question is... But I think the situation, again, is wherever you take your central registration. That is what I believe they are thinking of for all professionals. Wherever you take your registration is effectively where you will pay, irrespective of whether the taxable activity has arisen somewhere else. So therefore, let's say a surgeon travels recurrently across different states to perform surgeries. They don't expect it to sort of be paid. Whatever be his surgical fees, they are saying that there will be a central registration you can take.
The reason I asked was because many lawyers are having doubts. Because my primary place of business is in Mumbai, and I occasionally go to Supreme Court, occasionally go to Bangalore. What happens?
So that's exactly the issue they are contemplating, that there are medical professionals who also travel. There are certain other lawyers, chartered accountants. So they are trying to just try and base that on the basis of the registration which you take in what is supposed to be, therefore, your normal place of residence.
Yeah.
Is there any contemplation of reverse charge for goods transport and lawyers and
So-
so on?
So unfortunately, I find that in whatever little dialogue one has with the Ministry of Finance, lawyers seem to figure very low on their list of priorities.
But coming back to the point earlier which Rohan made, one of the discussions was that fine, I mean, as a chartered accountant, say we are primarily providing service from A area, but if we have another establishment somewhere else, and we are also, so what is that establishment? And that was not very clear, because what they asked us was that when you go for audit, and supposing you are there for 1 month, then that's your establishment. Why should we not consider you separate? So from Rohan, what you are saying, ideally, yes, and that's what we represented, and we explained that ultimately I am still providing service from a location. Just because I am going to some other location and my people are there for a few days does not mean that that becomes my establishment. Yeah,
Yeah,
some
this
sort
is,
of.
at least in lawyers, this is the exact Clifford Chance Linklater's issue. So,
Yeah, so yes.
which they are procuring, they can transfer by way of ISD invoice to the respective locations and it there. The GST, this common cost which has been incurred at the corporate office, which is for the benefit of all the 5 plants, whether it will be construed as a service provided, because in accounts or for the tax returns, the company might be allocating that cost even to the 5, or same ISD mechanism should be used because actually there is no consideration for the services because it's a corporate office which is merely allocating costs rather than actually raising the invoice.
So, you know what, this is an issue, self-supply, same entity making, providing services. I mean, managing director sitting in Mumbai office and working for all the plants across, this is an issue. Ideally, the way we have been explained was that it is only the inter-entity supplies without a consideration which are supposed to be taxed. That means if a managing director spends his time for a, let's say he's employed in XYZ Limited and there is a subsidiary ABC Limited also for which he spends time, then there may be a charge which is valid. But for the same entity is not valid. But that provision unfortunately is not coming out. So any self-supplies to a distinct taxable person are going to be taxed. Now there could, we have taken various examples, Mr. Satyapodar took various examples. And the examples can be ridiculous also. And it can be, you can come up with so many examples. How can this be determined? But I believe this law will need some clarity and amendment to make sure that these kind of self-supplies are not going to be taxed.
Just to supplement what Prashant said, see if the service what you are supply which you are referring about is a common
Corporate
resources
services
like MD or the HR head, etc. They are employees of the company, and the company means it is a legal entity across. Okay, it is not coming as a registered person. Any supply of service from an employee to an employer is the company, is not taxable, not a supply which is
Sir,
taxable.
sorry, just a small modification. That's a corporate office. All the employees who might be heading the different functions will be sitting here.
Correct. It's
Correct.
single legal entity, right?
Single legal entity having 5 plants. These all the legal or functional heads will be responsible for plants. So in that case, even if we consider it's a self-supply, whether corporate office has to raise an invoice for...
The question is not arising. There is no GST there because from the supply definition, any supply of service by a employee to an employer is exempted. So there is no question of valuing there.
I have a slightly different view. Essentially, the rules that are created at the state level in India are meant to be the mirror of the rules that apply at international level. So suppose you have the corporate head office in UK and they have a branch in India. So in that situation, will the transfer pricing rules apply to allocation of services between the head office and the branch? If so, you can be guaranteed the same amount will be subject to GST or IGST in the context of India.
Sir,
So that's a starting point. Now, in that context, what Sachin mentioned makes logical sense, that you don't want to tax services of an employee. But in the international context, head office management charging a fee to the branch is nothing but a recovery of the cost of the employees.
That is even today.
Yeah.
They have differentiated between a branch.
So in international scenario or the income tax or the transfer pricing, if foreign company is having a branch, if they are cross-charging to India, then it is a taxable transaction. You have to go through the transfer pricing regulations.
Yes.
But it doesn't apply when the Indian company having a branch outside India. It's the
Now
same
you have
resident.
to. Now that's exactly what has happened. And that's why this room will be full to overcapacity in 2 years' time.
I think, yeah.
Hi, sorry. I just had a question regarding export of services. I noticed there was one provision in the IG. India, it will be taxable under IGST. Any comments?
provider and service recipient are located within India, the place of supply will be the place of the recipient of service, who's a guy who's in India. Whereas if that service provider, one of the parties located outside India, is the location where it is held. So these are some of the misnomer in this. So there are some cases like that. Hopefully they will get addressed. Yeah, this is the last question. I think we are running out of time.
Sir, on the transfer of business or where we discussed sale of shares is outside the GST net, but when the business assets are transferred, those are considered as GST. But consider a scenario where you are acquiring the contracts, employees, and certain assets, but not the shares of that particular division or a unit of the overall entity. Would it fall under GST, or how it would be looked at? Because from a business perspective, it is similar to a going concern, but there is no clarity as such on this particular point.
Bhavna?
When you talk of business assets, business assets cover both tangible and intangible. So what you are saying, the customer list, etc., if you say it's intangible, it will still be covered.
Okay, so it will remain a business asset.
Yes.
Okay. Subject to GST.
So thank you so much for participating in this discussion and being here with us. And we thank all the speakers, panelists here for having a very enlightening session. I was expecting much more people here. How many of you are indirect tax guys? Okay, otherwise this would have been boiling. The room would have been boiling with questions. So thank you so much, and we hope to see you in our next program of FIT.
Thanks to Mr. Sachin Menon and Mr. Satya Poddar for chairing and leading the discussion. Thank you very much.
Thank you.